Most of us are taught from a young age that borrowing money is a mistake. The common wisdom is that loans are dangerous financial traps designed to keep you broke and struggling for years. But a loan itself has no intent. It is simply a neutral financial tool. At its core, borrowing is just an exchange. You receive immediate capital today, and in return, you agree to pay back a slightly larger amount of money over time. This mechanism is called leverage. Depending on how you deploy that upfront capital, that delayed cost will either systematically build your wealth or trigger a devastating cycle of debt. The outcome depends entirely on your strategy. To see exactly how this works, let's look at two individuals. We'll call them Person A and Person B. Both walk into the same bank. Both apply for a $20,000 loan, and both are approved under the exact same terms. By tracking where these identical loans end up, we can see exactly why one person achieves financial stability while the other faces ruin. The difference comes down strictly to how they deploy their newly acquired capital. Person A takes their $20,000 and immediately buys a luxury car. It's a vehicle that looks great, but realistically, it pushes well past what they can actually afford on their normal salary. This is a textbook case of lifestyle inflation. It's the strategic error of buying the external image of success before you've actually built the underlying income required to sustain it. Buying the car creates an immediate mathematical vulnerability. Lenders measure this vulnerability using a metric called the debt-to-income ratio, or DTI. You calculate DTI by taking your total monthly debt payments and dividing them by your gross monthly income. To see how this breaks down mathematically, we look at the formula. If Person A now owes $1,500 a month in total debt, divided by $5,000 in gross monthly income, their DTI hits 30%. That car payment is now consuming a huge portion of their incoming cash, leaving almost zero margin for error in their budget. And that $20,000 loan comes with interest. Over a long repayment term, Person A will end up paying thousands of dollars more than the original sticker price, all for a machine that loses value every single day. Then the structural failure happens. A medical bill or a home repair suddenly pops up. Because the car payment drained their cash flow, Person A has no emergency savings. To cover their basic living costs, they are forced to put those unexpected expenses onto high-interest credit cards. Person A is now stuck in a cycle of borrowing just to survive. Their original loan created a fixed, inescapable monthly bill, but it never generated a single dollar of new income to help pay for itself. Now let's look at Person B. They take their exact same $20,000 loan and deploy it strictly toward purchasing commercial business equipment. Before signing any paperwork, Person B ran the numbers. They calculated their existing debt to ensure their DTI stayed low, mapped out exactly where the monthly payment would come from, and verified that the interest rate made mathematical sense for their budget. By buying that equipment, Person B is using the loan as actual leverage. The equipment allows them to take on more work, which immediately generates a brand new recurring revenue stream. We map this on a flowchart. The $20,000 node converts to an asset, bringing in an additional $1,500 monthly. Instead of buying luxuries, they funnel a portion of revenue right back into loan payments, attacking the principal directly. By aggressively paying down the principal ahead of schedule, the math works in their favor. The total balance drops faster, which prevents the bank from charging them years of accumulated interest. Person B achieved positive leverage. The capital they borrowed purchased an asset that completely paid for its own debt, while permanently expanding their income and overall net worth. Looking at this side-by-side graph of their progress 5 years later, Person A and Person B are heading in radically different directions. The initial $20,000 of starting capital was completely irrelevant. The entire divergence comes down to the future value created by the asset they chose to buy. We can define bad debt as any capital borrowed for ego, social pressure, or temporary lifestyle upgrades. It is money spent to look rich today, guaranteeing that your future cash flow will be drained to pay for it. Good debt is capital borrowed strategically. It is used exclusively to increase your income, acquire valuable assets, or build skills that directly improve your professional earning potential. This leads to the ultimate rule of borrowing. You should never borrow capital to simulate the appearance of success. Debt should only be used as a lever to engineer genuine success. Ultimately, true financial power isn't about getting the bank to approve you for a massive loan limit. It's about having the strategic discipline to use outside capital to build your own internal wealth.